Have you ever wondered how professional traders analyze the stock market? A significant part of their strategy lies in understanding candlestick patterns. Now, what's a candlestick pattern, you ask? Well, it's a method of reading a chart used extensively in technical analysis of equity and currency price patterns. Each candlestick typically shows one day. Thus, a one-month chart may show the 20 trading days as 20 candlesticks. The colors of the candles, usually black or red and white or green, represent the market sentiment. A black or red candle signifies a price decline, while a white or green candle shows a price increase. Candlestick patterns are a form of technical analysis, and they can be used to predict price movements before they happen. It's like having a secret code to the market's moves. Knowing how to read these patterns can give you a significant edge in the market. So let's dive into these patterns and decode the market secrets together. Single candle patterns are the most basic form of candlestick patterns. They are the building blocks of more complex patterns and can provide valuable insight into potential market movements. Let's start with the shooting star. This is a bearish pattern that appears after an uptrend. It's characterized by a small body at the lower end and a long upper shadow. This indicates that the bulls tried to push the price up, but the bears fought back and brought it down, suggesting a potential reversal to the downside. Next, we have the hammer. This is a bullish pattern that usually forms during a downtrend. The hammer, like its namesake, appears to be hammering out a bottom in the market. It has a small body at the upper end and a long lower shadow. This shows that the bears tried to push the price down, but the bulls stepped in and drove it back up, hinting at a possible upward turn. The inverted hammer, on the other hand, is a bullish pattern that often occurs at the bottom of a downtrend. It's similar to the shooting star, but it appears after a downtrend instead of an uptrend. The inverted hammer has a small body at the lower end and a long upper shadow. This suggests that the bulls tried to rally the price, but the bears managed to bring it down. However, the fact that the price was able to push up significantly during the session indicates that bulls are starting to gain strength. These single candle patterns can provide early signals for potential market reversals. They are not foolproof, of course, and should always be used in conjunction with other technical analysis tools. But once you master them, they can be a powerful addition to your trading toolkit. Dual candle patterns offer more confirmation than single candle patterns. As we delve deeper into the world of candlestick charts, we come across dual candle patterns, which are essentially two candle formations that appear consecutively on the chart. These patterns provide more detailed insights and stronger signals about potential market movements. Let's start with the bullish and bearish engulfing patterns. A bullish engulfing pattern occurs when a small red candle is followed by a larger green candle that engulfs the previous candle. This pattern is a strong indicator of a potential upward trend. On the flip side, a bearish engulfing pattern is formed when a small green candle is followed by a larger red candle that engulfs it. This pattern signifies a possible downward trend. Next, we have the dark cloud cover and piercing line patterns. Dark cloud cover is a bearish reversal pattern that occurs at the end of an uptrend. It is formed by a long green candle followed by a red candle that opens higher than the green candle's high but closes below the midpoint of the green candle's body. The piercing line pattern is the bullish counterpart of the dark cloud cover. It occurs at the end of a downtrend and is formed by a long red candle followed by a green candle that opens lower than the red candle's low but closes above the midpoint of the red candle's body. These dual candle patterns play a crucial role in predicting market trends and can provide stronger signals for potential market reversals. Armed with the knowledge of these patterns, you can make more informed trading decisions. But remember, while these patterns can be helpful, they are not foolproof. Always consider other market factors and indicators before making a trading decision. And with that, we wrap up our discussion on dual candle patterns. Stay tuned for our next section where we explore the world of triple candle patterns. Until then, Keep charting and happy trading. Dual candle patterns can provide stronger signals for potential market reversals. Triple candle patterns are more complex but can provide more reliable signals. Let's delve into this fascinating aspect of candlestick charting. First up, we have the morning star and evening star patterns. The morning star pattern is a bullish reversal pattern that appears at the end of a downward trend. It consists of 3 candles, a long red candle followed by a small-bodied candle, which can be either red or green, that gaps below the first candle, and then a third green candle that closes within the body of the first candle. This pattern signifies a potential reversal in the market from bearish to bullish. The evening star, on the other hand, is a bearish reversal pattern that appears at the end of an upward trend. It's the mirror image of the morning star pattern, with the third candle closing within the body of the first candle, indicating a potential shift from a bullish to a bearish market. Next, we have the 3 white soldiers and the 3 black crows patterns. The 3 white soldiers pattern is a bullish signal that appears after a downtrend, consisting of 3 consecutive long green candles with higher closes each day. This pattern suggests that buyers have stepped in and a reversal in the market trend is likely. Conversely, the 3 black crows is a bearish pattern that appears after an uptrend. It consists of 3 consecutive long red candles with lower closes each day, indicating that sellers have taken control and a reversal in the market trend may be imminent. Understanding these triple candle patterns can be a game changer in your trading journey. They offer valuable insights into potential reversals in market trends, enabling you to make informed decisions and maximize your profit potential. Remember, these patterns are just one piece of the puzzle. Always consider them in conjunction with other technical analysis tools to increase the reliability of your predictions. While more complex triple candle patterns can offer more reliable signals for potential market trends, knowing candlestick patterns isn't enough. You need to know how to use them in your trading. Let's dive right in. Imagine you've just identified a bullish engulfing pattern. What's next? Well, this is where your trading strategy comes into play. You can use this pattern to establish both your stop loss and profit targets. Your stop loss should be set slightly below the low of the engulfing candle. This is because if the price falls below this level, the bullish trend you anticipated may not materialize. Your profit target, on the other hand, could be set at a resistance level or at a fixed profit-to-risk ratio. Now let's consider another scenario. Say you've spotted a bearish harami at the peak of an uptrend. This could be a signal to short sell the stock. Your stop loss could be set slightly above the high of the harami, and your profit target could be set at a support level. In both these examples, you're using the candlestick patterns not just to anticipate the market direction, but also to manage your risk. This is a crucial aspect of trading that often gets overlooked. Remember, in trading, managing your downside is just as important, if not more, than chasing the upside. Candlestick patterns can also be used in combination with other technical analysis tools. For instance, you could use moving averages to confirm the trend indicated by the candlestick pattern. Or you could use the relative strength index to identify overbought or oversold conditions, thereby improving the reliability of the signals generated by the candlestick patterns. In essence, candlestick patterns are not standalone tools. They should be used in conjunction with other technical analysis tools and within the framework of a well-defined trading strategy. This way, you can maximize their potential and improve your overall trading performance. By incorporating candlestick patterns into your trading strategy, you can improve your trading performance. Understanding candlestick patterns is a crucial skill for any trader. We've journeyed together from the basics, delving into single, dual, and triple candle patterns. We've learned how to interpret and use these patterns in our trading strategies, setting up our stop loss and profit targets. Remember, the power of candlestick patterns lies in their ability to provide a snapshot of investor sentiment. They're a powerful tool, but like any tool, their effectiveness depends on the skill of the user. Practice is key. The more you use them, the better you'll understand their nuances, and the more effectively you'll be able to apply them in your trading decisions. But don't stop here. The world of trading is vast and constantly evolving. Continuous learning is the hallmark of a successful trader, so keep practicing, keep learning, and you'll continue to improve your trading skills. Your journey to becoming a professional trader has just begun.